Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast.
Welcome to this episode of the Australian Finance Podcast. I'm Gemma Mitchell, and every Friday, Owen and I do a Q&A where you get to send in your questions and we'll answer them. Owen is currently on leave. He's gallivanting around the countryside. So I am very happy to be joined by one of our senior advisors in our Rask team, James Phelan. James, welcome to the podcast.
Yeah, glad to be here.
We've had you on before. I think you've done one Q&A before, have you? So you know how these roll?
Yeah, one quite a while ago now with Owen. But yeah, first time doing a potty with you, which is very exciting.
Excellent. Well, very excited to have you here. And we always kick off these sessions with a bit of an update on what has been happening in our week. So James, what have you been up to this week?
Busy. So yeah, the advice side of the business is absolutely mental, which I think yourself, Tarly, Owen have all mentioned many times, but it's not slowing down at any point. But I think I've been doing a little bit of self-reflection this week and realising that there is no two people that are the same in advice. It's everyone has their own set of unique circumstances, and the Rask community is no different.
Yes. And I think, a lot of the time, there's so many strategies that are the same. There's only so many ways you can do things, but every single person is so unique in what ends up being in their statement of advice and how we work with them because of their goals and all of that kind of stuff, the approach they have to money. So it's really interesting, isn't it? Lots of variety with the client base.
Yes. Yeah, definitely not bored.
Yes. So Owen and I were in Sydney last week with a lot of the other team, which was awesome. We went to the Her Wealth, Her Way event by Mel Brown, and that was absolutely amazing. So that was really, really busy, and Owen's got this week off. I think we're moving offices when this goes live, which will be Friday the 3rd. The team in Melbourne will be moving offices. They're just changing offices on the same floor. So they'll all be very, very hectic and busy when this comes out. But excited to get into it. We've got some great questions today. We're going through investment bonds, some pension, as in like the age pension, Centrelink. We've got some on investing, property, and financial advisors fees, lots of good stuff. But before we get into it, like always, it's really important that if James and I do talk about any products or strategies or specific shares, ETFs today, it is very important that you take this as education for information purposes. You always need to do your own research before you dive into any strategies and products. This is for education and entertainment purposes, and we want you to make sure you get advice that's right for you. We don't know your needs, goals, and objectives, so don't rush out of here and do anything we talk about. Make sure you do your own research. But let's jump into it. So, James, you're in the hot seat today. I'm going to be asking the questions. And the first one is from Centre Help. How does the age pension work? How does it work with super? And can you have both? This is a great question. I don't think in my time on the Q&A, doing the Q&A with Owen, we've had a Centrelink, like an age pension one before. So this is great. And it's also topical because there has just been indexation to the age pension, like the deeming rates just recently as well. So this is a great one. But James, tell us, what is the age pension? How does it work? And how does it work with super?
So the age pension, some people might know, but essentially it's the government providing social security benefits to older Australians so they can get through retirement if they don't have the ability to self-fund their own retirement. So when you turn 67, make an application for the age pension, Centrelink will review your assets and also your income and do a couple of tests to basically assess whether you're eligible. And when they run both those tests, they'll take the lower value from both. So if you can get X amount of pension from the asset test, but only Y amount of pension from the income test, and it's less, then they'll pay you that lesser amount. So you can have super and the age pension. In fact, I think that's probably most common among older Australians, is that they have a little bit of age pension and they're also contributing to their own retirement through superannuation. So, but essentially, super only counts to the asset test of age pension once the individual reaches 67. So quite often, if you have a couple who are both approaching age pension age, but say one might be 67 and the other one might be 64, it can be a common strategy for the younger partner to hold more assets in their super accumulation, and therefore the older partner is eligible for more age pension than what they would have been, or even at all. So surprisingly, you can actually have quite a lot of assets and still get at least a part age pension. So currently the asset test is a little bit over $1 million before you stop getting any pension at all. But even if you aren't eligible for the age pension straight away at age 67, that's not to say that you might not be at 70 or 73, as the thresholds for that Centrelink and that deeming that you spoke about before, that increases over time. So, and your assets might decrease as you spend your money in retirement. So it's not just get to 67 and you are or you aren't eligible. It's an ongoing test as your assets values change over time.
Yeah, I think when we do like retirement graphs and things, whether it's in advice or there's some great online calculators, your super fund might actually have a retirement calculator that includes age pension. And a lot of the time, as you said, we see people, it kind of might start really low or no eligibility initially, and then it comes into play later on. And, it might be initially you're what we consider self-funded. You're relying completely on your assets, your own assets, like your super investment properties, whatever it is. And then it might be at some point you're actually it's being topped up. So you're doing some of your own assets and there's some Centrelinks coming in. And then for other people, it might be they're completely self-funded. So there's that middle ground where I find most Australians probably fit, where we see a lot, is that some money's coming from your super and some's coming from the age pension. And how you do that is, if you're moving from accumulation super into pension mode within your superannuation, so now you're drawing a payment out, you might have that payment coming out fortnightly. You might need $1,000. $500 might be coming a fortnight from, these are very low figures, this would be nice, but for simplicity. So $500 might be coming from the age pension each fortnight. If you needed $1,000, you'd get $500 from your super. So yeah, it's just about balancing it. And as those rates change, you just adjust what comes from super and what goes from pension. But that strategy you mentioned about the younger spouse, I absolutely love that, because you can maximize Centrelink, and it might just be for a few years. And that might be the only years that you actually get the pension while there's an age gap between the two of you. So I would really recommend financial advice as you're coming up to that stage so that you can maximize it. And there are some assets that help you that are treated a little bit different in the age pension when they're assessing your assets and your income. So there are ways that financial advisors can help you maximize that and get, everything that you can, which in turn makes your own money last longer because you don't have to be so reliant on it.
That's right. And quick shout out to Tali as well, part of the advice team. She's in the process of finalising her retirement course. So it talks through all of this stuff in detail. So if you're looking to learn a little bit more, keep an eye out for that one.
Yes, that's going to be great. I think that's probably at the moment our most popular courses are like the share investing ETF, but there's a superannuation one that really is. And I honestly think the retirement one will just shoot up in, that'll be very, very popular. So speaking of superannuation, the next question is from Super Confused. They ask, what happens to my super if I die and I don't have a will? So this one is a very important and lots of misconception on and misunderstandings on what actually happens with super, your will, all those types of things. So James, tell us your wisdom in this area.
So super does not automatically form a part of your estate when you pass away. So it's own trust managed by the super fund trustee on behalf of you. And essentially, if you pass away and you don't have a will and potentially you don't have a beneficiary nominated on your super fund, then the super fund trustee has the discretion to how they pay that out. Now, will it fall under what you may have intended with a will anyway? Maybe, but there's no certainty there. So essentially, what we do with super, what we look at with clients is we try and have a binding nomination in place. So that is you telling the super fund, this is where I want you to pay my super benefits to, and you are obligated to, as long as it's a valid nomination. So by valid, there is only certain people that are eligible to be nominated as your beneficiary in superannuation. Most commonly, that's the spouse, kids, someone who's financially dependent on you, potentially, or you can actually nominate it to go to your estate via your, what they call your legal personal representative. So one trap that we see some people fall into is that they might be nominating someone who's not an eligible beneficiary, such as a parent or a sibling, people that
That's a
aren't
very common one. Parents and siblings we see all the time. And if you can't prove that you're in a financial interdependent, like you're dependent on each other financially, then they're not actually eligible for it.
That's right. And with these binding nominations too, some super funds, they do lapse after a few years. So whereas other funds might have an option which is non-lapsing, and that is you make the nomination once, and unless you change it, it stands for the test of time.
Yeah, and a lot of the time I see people go, oh, I want it to be non-lapsing because they see that as less risk, you know, they won't forget to update it. But there is risk with it staying in place forever and you forgetting to update it. You know, you might be not with this person anymore. It might have been a de facto relationship or a spouse. They might still be listed. So if it's if it's non-lapsing and it's in place, you still need to be checking it. And it might be that it's lapses every 3 years, but this is one of those things that you should be checking every single year. So with your super, you should be getting your super statement, checking your investments, what insurance you have, and your beneficiary every single year, just to make sure that it is, up to date. But so you can't directly nominate siblings or parents to get your super, but as James said, you could put that a consideration in your will and then tell the super fund in a nomination that you want it to be paid in line with your will via your legal representative. So there is a way to do it. It's not like, no, you can't do that. There is always a way to do the things that you want to do. You just need to get the advice from, you know, like a solicitor, an estate planning lawyer, and make sure that you have your wishes, like it all set up so that that is actually going to happen. It's so important that your wishes are followed. And a point on the wills, I always hear people say stuff like, oh, I don't need a will. I don't really have that many assets. And I'm like, everybody needs a will. Everybody has a bank account. You might have a car. You might have a super fund that you need to kind of put that through, link that together. You might have digital assets, but not having a will is a nightmare for your family to deal with. And I just don't want people to put that burden on their family. So even if it's not important to you, everybody should have a will, even if it is the most basic of wills. It's a huge gift to your family. Otherwise, it's quite a nightmare for them to deal with this stuff.
Yeah, you hear about it so often, families struggling to sort out the estate of someone who didn't have a will. And it's a relatively simple process to get one in place. It doesn't have to be complicated. It just has to be there.
Exactly. Yes. It's timely, stressful, and expensive for them to deal with. So just do yourself a favour and get a will. Okay, so next one, no name came through with this one, but we have the question. Bought my first property a year ago and I've started investing in ETFs. Should I be more focused on paying down my mortgage or investing in the ETFs more? I've heard you speak about debt recycling and I don't know how that works and I'm not in a position, and I don't know if I'm in a position for that to benefit me. Okay, so a bit here. So first part of this question is, we've got a new mortgage. I'm assuming that this person is living in their house, in the house that they've bought. So they've got a principal place of residence mortgage, and they've also started investing in ETFs. So the first question is, which one should they be focusing on? And then the second part is, what is debt recycling, and how do we know if it benefits them?
Do you think that this dilemma of paying off a mortgage or investing in ETFs might be one of the most common issues we hear?
Absolutely.
Yeah.
And I think our answer always, spoiler, comes down to, why not a little bit of both? But yeah, let's dive into it. We hear this all the time. And debt recycling might be that middle ground, right? But that's not a really simple. That's not for everybody. But okay. Well, talk to us about paying down debt versus investing. Where do you sit in this?
So exactly what you said. I'm in the camp of a bit of both can work. Now, when we look at it from an advice perspective, it comes down to the individual's personal risk tolerance. Some people don't like having debt. Some people prefer to pay off their debt as quickly as possible. Other people would be happy to carry debt on for as long as they can. But essentially, by paying extra off your mortgage or holding a larger balance in an offset account, you are getting a risk-free after-tax return equal to whatever your mortgage rate is at that time. Now, if that's 5 or 6%, you compare that with what you might get in a diversified ETF portfolio, which longer term might sit somewhere between 7 and 10%, maybe higher, maybe a little bit lower, depending on volatility. But essentially, that ETF portfolio is at risk, and it's also taxable for any of the income that's generated from it. So that return can be depressed down a little bit when you compare it with just paying down your loan. However, with debt recycling, you're almost kind of marrying the two ideas. So you are making that conscious effort to make extra repayments off your home loan, where you can then redraw those funds to invest in ETFs. So at its crux, it's about turning non-deductible debt, which is your primary mortgage, into deductible debt, which you would then be utilizing to buy income-producing ETFs. So whether that's suitable to you or not, once again, it comes down to your risk tolerance, whether you are okay with having debt longer term. Do you have the right loan structures in place? Do you understand that leveraging investments can be risky? It's not a strategy that you would be considering if you are potentially thinking about moving soon, or you had ideas of purchasing an investment property, or if your loan isn't structured correctly. But it is a great strategy for the right person. It just requires a bit of discipline and the right circumstances.
Yeah, I think that's key. I love that, the discipline, because right now we hear so much about debt recycling. You know, I think every second question that comes through is about debt recycling. Open social media, they're talking about that, or spruiking buying properties in trusts and things. It's kind of like the hot topic at the moment. But it can be done really, really well, and it can also be done not so well and add lots of complexity and just be a nightmare. So getting the information right is so important. And I'll put, I think we've got some fact sheets and things on debt recycling, so I can put them in the show notes so you can get some more information there. But if you are considering debt recycling, I'd be talking to a financial advisor or accountant on the structure and different things, and if it works for you, and if there's going to be enough benefit for maybe the complexity and things that you're considering. From a very simplistic back to the investing versus debt, I think even if debt is your priority, it's great to be doing a little bit of investing purely so you're on that learning curve. It doesn't have to be your whole strategy. It might just help you with your confidence and your knowledge. So there's a lot of power in that, even if it's not your full focus. Okay, and our final question from today comes from my favorite name, Cash Me Outside. So do you know that reference?
Yes,
The girl that what was she on? Dr. Phil or something?
Yeah.
Cash Me Outside. I'm probably not saying it like with the dramatic affected that I should, but absolutely love this name, Cash Me Outside. Okay, so I'm a first-time writer innerer, long-time podcast listener. My financial advisor has suggested I get a wrap account instead of my current super account. Are financial advisors usually incentivized to move super investments into wrap accounts? Okay, so a bit in this, and we don't know your circumstances. I'm sure your financial advisor is looking at the absolute best setup for you, but maybe we dive into first part of this, James. What is a wrap account?
So a wrap account is shortened like a wrapper. So it's basically an investment platform that can house different types of assets under the one umbrella.
Yeah, that's the thing. It can be a bit of a middle ground from maybe you don't have all of the flexibility that you need in a more standard super fund like an industry fund or a retail, but you don't want to be going into a self-managed super fund. So a wrap account can be that kind of hybrid approach. Fee-wise, they're usually pretty good. Like fee-wise, a lot of the time, generalizing, of course, because of the different assets you can put in them, it can be a way to lower your fees, I've found. So that can be a good thing. But is the advisor incentivized? Well, James, tell us about that. How do the fees work in these types? And, does an advisor have to be attached? Is a wrap account something that you could do on your own without an advisor?
Kickbacks, commissions, they've been banned since 2013. So an advisor's not going to receive anything from that aspect for putting you on a wrap account. But what they do add for an advice firm is basically consolidating your client base onto one platform, which eases the compliance burden. Now, advice is expensive in Australia, and dealing with dozens of different super funds if you're operating a firm and have a large client base increases that compliance burden. So there is some incentive there. There may be other incentives, like for us here at Rask, we have a preferred wrap platform provider, and it's our preferred provider because you can operate it without a listed advisor. So we're not in the business in locking people into a long-term contract if it's not suited to them or if they don't want that. And we feel that if the wrap platform happens to be suitable to that client, they can still have it without being locked into our service.
Yeah, absolutely. So if your advisor puts you into a wrap account with a lot of firms, they will charge an advisor fee out of that, and that's to pay for that funds your ongoing service and agreement with the financial advisor, and they should be actively kind of managing that relationship with you and looking after the product for you. So we do at Rask Advice have a wrap account because they do suit like a lot of our clients. So we have a wrap account provider that is our preferred. We can work with any if they suit your needs, but we have a go-to that we are most comfortable with, and for exactly the reasons that James said is they're just as good dealing with you directly as they are an advisor. And there are some wrap platforms that you have to have an advisor attached to. You couldn't, remove them. So it was really important to us as a firm when we were looking at who would be our kind of preferred, how they would work with the general public rather than directly just with advisors. So these are the types of questions that when you're meeting with an advisor, you want to ask, why is that more beneficial than the current structure I've got? And it might come down to fees. It might come down to the types of assets that they want to put you in that they think will meet your goals better. But it's just about you really clearly understanding and looking at the fees and things as well. But for higher balances, a lot of the time I do see wrap accounts really lower fees. So getting really detailed with your advisor, looking at your statement of advice, comparing the fees and the investments that they're recommending is going to be really important for you to decide if that is in your best interest. But as a financial advisor, and James, we would hope that all financial advisors are doing what's in your best interest. The important thing is they can articulate it to you in language that you can understand and you're confident on why it is in your best interest. And it's important, like a wrap account can be your own investments, like within your own name. It can be in a company structure, or it could be superannuation. So it's not just super that has this. It's like an investment wrap platform, kind of like a brokerage where you can pick lots of different things. It wraps it all together and then gives you a statement each year and all of those types of things. So it can be that hybrid middle ground from completely having it done for you versus doing it like a self-managed super fund. But great question and great name. So today, James and I have gone through a Centrelink around age pension and those types of assessments. We talked about what happens with your superannuation if you pass away and you don't have a will. We just ran through all of the things about wrap accounts and some info on financial advisors, what to ask. So lots of different stuff in today's. I hope you got a lot out of this. If you have a question that you'd like answered on the podcast, so these episodes go out every Friday. If you have a question, make sure you head to your show notes. There's a link there where you can send in your questions. Make sure you have a really great name. We love to laugh at the names that come through, so get creative. But James, thank you so much for joining me on this episode of the Australian Finance Podcast.
Thanks for having me.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.